All right, now we're bringing in the aforementioned Skip Sims, who I've known. I don't know. I forgot how long I've known you, but it's been a long time.
It's been a long time.
Long time. And Skip is at Ann Arbor Spark. I believe you're still the managing partner for Michigan Angels. Did I get that right?
Yes, Michigan Angel Fund. Yep.
Yeah, I didn't think that changed, but who knows? So. But let's talk a little bit about that. Now, we just talked about the overall investment private equity in Michigan and how venture capitalists are really, when you're in the ballpark for looking for millions of dollars, you go to a VC. But when you're like a little company like mine and you've got some projects moving forward where you don't need millions of dollars, there is the angel investors. But even then, as we were talking about, every angel group has a different sweet spot. So you've got to really shop around, right?
That's right. I mean, angel groups, just like VCs, have different focuses, different models, different criteria. So yeah, you need to shop around and don't waste your time as the entrepreneur or the investor's time by applying to a group or pitching to an individual who's made it clear through their website or other that you don't fit their criteria.
Right.
And all that does is reinforce why we're not going to invest in you. You didn't do your homework.
Yeah, that's a good starting point. The other thing now, let's talk a little bit about your particular group. Last I knew, you were the largest angel group in the state. Is that still true?
Well, I think so. The guys in Grand Rapids, the Grand Angels, actually have created another organization, Michigan Capital Angel Network of some kind,
right.
where they're actually providing the back office for multiple groups. And so I guess it kind of depends on how you count it. But we've got about 160 people that are that have participated with the Michigan Angel Fund over the past 8 years now.
And what is your particular sweet spot? What do you like? What does your group like to invest in?
Our particular group invests only in Michigan's early stage companies, only in technology companies that have the ability to scale and that will be building their businesses in a very large market. So that's our core criteria. As with VCs, this is a little bit in the weeds, but as with VCs, most angel groups now also, we only invest in C Corps. So if you're looking for, investment from angel groups in particular, you need to be planning on, if you aren't already converted to a C Corp versus an LLC. We do not do real estate. We don't do gambling. We don't do crypto. We don't do other funds. We make direct investments into early stage and startup companies.
Why don't we start off too with talking about not so much what you invest in, but if you want to be an angel investor, what the criteria is. Now, I knew that was getting ready to change. I don't know if it's actually changed. Now, what's the current criteria?
It hasn't changed yet, but it's about to. Current criteria is your household has to have a liquid net worth of at least $1 million. And that means liquid net worth exclude any value you might put on your primary residence, your home, for example. Can't count that. But if you've got $1 million in a savings account and your IRA and various other things, then you're what's considered a qualified investor or a high net worth household. So that's criteria number one. Another way is if you make $200,000 a year or have for 2 consecutive years, you're a qualified investor. And where the rule is going to change is they're going to allow people that do not have $1 million net worth, but professionally are experienced investors. Then you can qualify, check a box and say, yeah, I know what I'm doing. I'm sophisticated. And therefore I recognize the degree of risk I'm taking and I can do it.
Yeah, that is the issue for like any other investment. There's no guarantee. I've just seen various numbers that out of 100 investments, maybe only 4 or 5 really do well, right?
Oh, it'd be more than that. But I think the point, to your point, let's face it, and this has been the case for decades. You go back and pull data from a variety of sources. Half of all companies starting up today will not be around 5 years from now. They will have gone out of business. And investors will have lost their money. They might have gotten a little bit back, but they certainly wouldn't be getting back all their capital, and usually you lose it all. You have to have a risk appetite that you can handle that and recognize that, my return as an angel investor is on my entire portfolio, if you will. All of these startup companies that I've invested in collectively as a pool is how you need to measure your success. You're going to write some off, and you can write it off on your taxes. So there's a little bit of a tiny return there. But I would say you should, if you're smart about it, you should be able to get your money back or most of your money back on at least half of the companies you invest in, and probably 10 to 20% of the companies you invest in should give you a nice profit, nice return on your investment that'll more than make up for those that you write off.
How would you define a nice investment without naming names? Kind of talk about what your experience has been in that area.
Well, we had a company, this is our big success story to date. We had a company where we were only invested for 16 months, and a private equity came along, said, we need to own 51% of the company. Do any shareholders want to sell? And we said, well, if the price is right, we will. And so in 16 months, we got 4 times our money back. Now, that's unusual, but that's what you're looking for. And that made up for a lot of other companies that we didn't do so well with our investments. We had another company that exited in 2021 that we ended up with about 2.5 times our money back. And that's the kind of the norm. Successful angels, they'll tell you over a 10-year period, the portfolio that they've got, they'll get about 2.5 times their money back.
Now, can you name some of the more successful investments that you've done, or is that proprietary?
Well, some of it's proprietary. We leave it up to the company to announce. We encourage them to make a big deal out of it. One of the things, you were talking about Ara, and he rightfully talked about Midwest values and the way we look at things differently in the Midwest. And one of the things, quite often we're a little bit too shy or humble, and we don't toot our own horn enough like they do on, the West Coast in particular. And we should. But again, being the nice down-home people that we are, we don't brag a lot as much as we should. And so we'll leave it up to the company to let it be known who they are and what kind of return they got. Although I have put on my LinkedIn once in a while that investment we had and return we had in 2021. I did put on there, hey, we just exited from X company and we had a 26% IRR on that return. I'll do things like that.
Sure. Okay. How often do you guys meet? Do you meet like once a month or so? And is there buy-in where you've got to commit to spending so much money a year or anything like that?
Each group is different again. Just as they have criteria for their investments, they have a criteria for their members. It's pretty common, as you just mentioned, for a person to join a group. They have to pay maybe an annual fee. And then they have to make a commitment to invest X amount of money in X number of companies in the course of a year or two. Not in our case. Our group is basically you put money into a fund. To be in our group, you put the money in the fund, and the fund is a sidecar to direct investments that others make. And there's no additional fee or charge to being a member of the Michigan Angel Fund beyond that. Mm-hmm. And then in terms of how often we meet, before the pandemic, I would say that, most angel groups try and meet once a month. And that was our modus operandi for many, many years. But since the pandemic and meetings have now become virtual, we'll meet anytime. We met twice in November. And there have been months we've not met at all. You got to have a reasonable deal. I'm not going to put just any company in front of our group. They're pre-screened, and we bring real opportunities in front of our members, and then all of them have the opportunity to make a direct investment. And if they do, then they have the fund they can call on to provide a little additional capital.
Now, Ara from the MVCA mentioned that there is a certain, I'm trying to think of the right way to phrase this, that there's certain criteria that you need to look at overall. I mean, in the sense of And you work with Spark. I guess this would be a better angle to hit with. He was saying that it really is necessary for a beginning entrepreneur to work with a group like Spark to understand how to approach angels if that's the direction you're eventually going in. Would you say that's correct?
Yeah, I think there's a lot of organizations out there that entrepreneurs ought to be tapping into. The New Enterprise Forum is a group of volunteers that help with your actual investor pitch and make it nice and tight and succinct and clear and covering all the elements that an investor wants to know, particularly on the first introduction. But you've got smart zones and accelerators that have all around the state that you should be taking advantage of, that can provide you a lot of mentoring and a lot of coaching, and a lot of it's free. A lot of boot camps various groups offer, and entrepreneurs ought to take advantage of all of those. And the one thing I stress to entrepreneurs is bootstrap as long as you possibly can, because as soon as you take on an investor, and I don't think most entrepreneurs appreciate this until it's well down the road. Two things happen. One, you've got a boss. These investors become kind of your boss. We're stockholders. You've got to report to us. And then secondly, and as a result, you'll have a board of directors that you really report to. But nonetheless, part two of that, though, is for every bit of equity you sell to an investor, it's coming out of your equity. So you go from owning 100% of the company to 80% to 50% to 20%. So you don't want to raise any more equity than you absolutely have to, until you have to. But when it's time to grow, get that capital and try and do that hockey stick thing. Grow fast, grow big, because even if you only end up with 20% of the company at the end of the day, if you go from being a company worth $1 million versus $100 million, you're still way ahead of the game and you'll do all right.
Yeah, I suppose 20% of $100 million would be pretty good walking around money, right? Don't you think?
Yeah, that'd be a nice return for your
Yeah.
efforts.
Okay. As a disclaimer, I am working with Spark. I won't talk about my projects. I don't want to be that self-promoting, but they've provided me with money and help and a lot of expertise. And actually, Skip was the person I went to originally when I started talking about my project.
And I hope I was tough on you too. I gave you all the.
You were, yes, right? But yeah, we're not quite there yet. We still have a lot of things that we're developing on that, but it's certainly the Spark money helped me pay for the lawyer fees and the trademark fees and the website fees. And now again, I'm not going to talk about my specific project, but I was just thanking Spark for all the help that they've provided so far. And of course, I'll be back again. And for folks that don't know what Ann Arbor Spark is, why don't you quickly just talk about what that is?
We're the economic development group for the greater Ann Arbor region, and about half of our activity, though, is all about startups, entrepreneurs, education, training, consulting, providing support services to get startups on their feet and get going and creating businesses, which then, as you grow, you create jobs, and that's economic development.
There you go. All right. Sounds great. And so, what would you recommend now? We've probably got some entrepreneurs that will either see this live or on demand. If the first thing, of course, as you said, do your homework. And how do they do their homework?
Well, I put our website up on the chat, and so go to our website, and right there on our website, we clearly tell you what our criteria is. And if you don't meet it, don't apply. I also gave you my email, and you can email me with your business plan. That's something that seems to have gone by the wayside, and entrepreneurs think they can get away with an executive summary or just a pitch deck. Not true. You might on the first visit, but eventually I'm going to want a business plan. I want to see the whole, your whole goals and objectives, et cetera. So plan on writing one anyway. So that's where you start. And I want to, Mike, if you don't mind, make a pitch for households in Michigan, and we've got a lot of them that are high net worth households. They're worth millions, and I would like them, if they aren't already, to consider investing in startups as an asset class. A lot of them are looking for alternative investments, but alternative investments historically, and still the case, real estate, classic alternative investment. Now cryptocurrency, classic alternative investment, gold, whatever. Investing in startup companies is an asset class too. It's risky, no question. You can't get your money back right away. It's not something you can buy today and sell the stock tomorrow. It's not going to work that way. But join a group and learn what it's about. And I think you would have a lot of fun and make money at the same time.